What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 20th of 2024. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I not only got a jam-packed interview with one of my closest friends and macro traders in the broader crypto and equity space, but beyond that as well, I want to spend some time today to talk to you guys about one of the biggest updates we've had for the DataDash channel since its inception in 2017. Back in 2023, I was thinking a lot about how I wanted to improve the DataDash channel and really the next chapter where we could take the channel going forward in the next couple of years. I think this channel is a great place where you can find trustworthy content and, most importantly, get a 360-degree view on all the opportunities going on in the world, not just in crypto. Well, because of that, I wanted to work towards expanding the team. And after a lot of applicants and a lot of consideration, I found an individual who I really believe is a perfect fit for the channel. This is an individual known as Russ. I've gotten to know Russ over the last couple of months through a mutual contact. And as time progressed, I really got to learn a lot about Russ's trading style, his focus on the broader macrosphere, and how he looks at financial markets. Now, before we dive into this interview with Russ and talk about some of the details around what he's thinking on markets, I want to make something very clear here, guys. This is not me going away from the channel. I still want to create content here. In fact, I'm going to be creating content on every Monday and Wednesday. He's going to start by replacing the Friday uploads, and maybe over time, we'll start taking on more responsibilities. But the key goal here is essentially to allow me to focus on creating more quality content. For me, I've been in a routine where I'm creating 3 updates every single week, nonstop, almost coming up on nearly 1,500 videos over the past couple of years, not to mention additional live streams and other features on different platforms. It's getting to the point here where I'm not creating my best content, so I want to make sure that I can do even better. And by having Russ on board and providing his fresh perspective as well, I think this is going to add even more value to the DataDash channel long term. And for transparency's sake, I want to let you guys know that we had dozens of people applying for this creator role on the DataDash channel when we opened it up back a couple months ago. And for those of you who did apply and didn't make it, I want to say thank you for taking the time to apply, and always keep in mind that there may be more roles open in the future. But to those of you who are listening here today and watch the channel on a routine basis, who put your trust in the DataDash channel, I want to make it very clear that Russ met 3 very important criteria that I would set for anyone joining the channel. He not only speaks his own mind, he's a fresh perspective. He's not someone who's just going to parrot all my talking points and viewpoints on markets, which I think is very important for this channel to survive long term. But outside of that as well, it's very important to understand that I think Russ has a strong technical background. He's been trading in financial markets over the last couple of years, has a strong background in mathematics, as well as consulting at some of the largest firms in the world. But outside of this as well, I think above all, Russ meets the ethos of this channel, being a place where you guys can get honest takes on the market. And sometimes we're going to get it right, and sometimes we're going to get it wrong. But overall, you can know at this channel, we're transparent. Whenever we do sponsorships, whenever we are covering particular markets, where we're invested in the market, we always want to do our best to give you guys a candid, honest opinion, cutting out the FOMO and all the fun. So without further ado, I hope you guys enjoy this interview with Russ. I hope you look forward to him creating more content here in this channel. And let me know what you think about the conversation down below in the comments. But nonetheless, let's go ahead and kick off the interview with Russ. All right, everyone. It has been a long time coming, but I'm finally here with my good friend Russ, who's going to be here on the DataDash channel from time to time. Russ, thank you, man, for coming on today. I'm excited to dive into a whole range of topics, dive into the macro. I want to definitely talk to you a little bit about what's going on in Bitcoin and crypto and just kind of get your take with the changing dynamics of the ETF. We've also got a ton to talk about in the macro. We get the inflation print coming up soon, what this is going to mean for equities, NVIDIA, the AI trend, over near $1,000 per share. And outside of that as well, I wanted to kind of let people get to know you a bit more on your side as a trader. Everyone's kind of different in that regard. So anyways, man, again, pleasure to have you here. Thanks for making the time, Russ, as always. It's a pleasure to have you on, man.
Hi, Nick. Hi, everyone. Indeed, guys, a very, very important week. I'd like to share a lot, so let's see what we can cover. For me, it is super, super important to start actually where we are macro-wise. So I'm going to share my screen, and then let's dive into our CPI prints. You see here 5 green numbers, and those 5 green numbers out of the last 7 CPI prints are actually quite a bad signal. That means that Federal Reserve is quite behind the forecast. The actuals are coming way hotter than expected, and definitely that concerns the market. Right now, let's see in which way it can concern the market, because one important thing that I also like to share before we move forward is that we are right now at this 525 to 5.5 Fed target rate. Is it really resembles, it reminds me the situation of the late 2005 to early 2006, and we only start having the cuts first is 50 basis points starting from September 2007. So I'd like actually to reflect those moments in time on the S&P 500 chart. I actually highlighted already those areas here on the rectangles that you can see. That was the moment where we in 2006 started to slow down the hikes, and then almost like a year from there, towards September 2007, we start having those huge drop. But the period of time and a year within, we had very similar number of green S&P 500 months that only started to look a little bit like a distribution here. So what does it mean in my opinion? I think that it's quite clearly signifies that Fed is significantly behind the curve. It also means, in my opinion, that they only can change slower, and this is very bullish for the markets. The outcome is simple. The slow snail that we're experiencing right now, at least until July, and why July we'll see in a second, because actually market prices that opportunities based on the participants' expectations. But for now, I think this slow snail is very bullish. The bull is called bull because he slowly goes through the field, and he eats up all the grass he wants, and there is not much that can stop him. And I think the environment right now is quite similar to that. When we speak about inflation, we also need to keep in mind that inflation is sticky. It can be very sticky. We might enter also, unfortunately, for many smaller businesses, we can enter the Paul Volcker times of 80s, where Volcker really had to step in, bringing those unprecedented, two-digit Fed target interest rates, and they were there to combat the wage price spiral. We are not yet there. We're still speaking about if Fed going to put the target inflation to 2% or to 3%. But right now, the whole idea of Fed still coming on the conference and speaking about the cuts, that is very, very bullish in my opinion, right? Mm-hmm. It's not bullish necessarily because of the Goldilocks scenario when economy stays strong, even though that's also in place. I would say that the JOLTS job data that was coming out in the last few months clearly signified that there is the number of unemployment claims is significantly lower than the forecast. So we can also stay in a prolonged Goldilocks scenario. But in my opinion, and that's actually very, very important, independently of both scenarios that's going to take place, either recessional or the Goldilocks environment, we are still going to be, for the next few months, in the either artificial or not, but the bull market, because prices of assets are also the prices. And if everything is inflated and the GDP numbers are inflated and the iPhone prices are inflated and the components of those prices of those iPhones are inflated, that also affects, of course, the EBITDA, the revenues, and thus it also affects the stock prices. So let's, yeah.
Yeah, just wanted to kind of contextualize your point, just to make sure I understand as well, Russ. Like, you're essentially saying there's an important relationship between the rate of inflation, the rate of interest rates, and also the performance of equities. And what you were kind of pinpointing is that we're in this like kind of, I guess, golden window of opportunity where things continue to extend when I think a lot of people probably don't expect it. Essentially, where rates have capped out, and before those cuts actually kick in, equities can have this grace period. They keep moving higher. The bulls kind of charge on, continue paying higher premium on the risk on narratives. And then you start to see those signs of distribution stalling the trend. And it tends to align with those interest rate cuts. When people ironically think, cuts in interest rates means cheaper liquidity, it's a good time. But that's usually your kind of precursor towards a broader recession or cool down. So, irrespective, maybe while there might be some kind of cool down in the next week or so, the general broader trend is going to be positive. It's going to be bullish until going July. That's kind of your thinking on it.
Yes, Nick, absolutely. And the reason why I mentioned July, because if you go here on the Fed Watch tool, that's an official CME group
Yeah, the prediction
website.
markets are in the CME. Yeah.
Right, right. So you can see that if we are talking about March or May, absolutely pretty much none of the market participants are expecting the cut. Our bracket target rate is still 525 to 5.5, where it is right now. However, when we are moving into July, and we'll see that the majority of participants are actually expecting the cut to take place. The question is if we're going to have 3 cuts this year. Initially, multiple analysts believe that's going to be 4 cuts. But once again, as I said, independently, if we're even going to have 2 cuts only, that's still very, very dovish scenario for the market. And in my opinion, first of all, until that period of time, we should stay bullish. Within that period of time, I also don't think, and we can cover it in a separate call because it's a little bit more complicated, that we are clearly copycatting 2005, 2006 scenario. I think we have a way more market tools right now, including the reverse repurchase agreement. And also, as you remember last week when Janet Yellen came out and said that, her statement about inflation being transitory, unfortunately was a mistake. So, bond market, in my opinion, it's so much more big than the stock market. And we have so many instruments there, including the yield curve control and others that can also provide additional liquidity to those markets. I would stay definitely bullish until July and cautiously bullish until November, right? Now, let's maybe still important to remind everyone, what does that mean for the markets and for Bitcoin and for other asset classes, right? It does not mean to go and jump and buy Bitcoin here. I propose we quickly go into the slides, and in the next 10 minutes, we cover the crypto market briefly, and we're also going to cover an asset class that I believe have probably a better risk reward here from there, from now onwards. So when we are looking at a trading view, one thing I also wanted to show is the function of liquidity. As you can see on the monthly time frame, 6 main central banks around the world definitely were not shy to provide additional liquidity into the markets. We are around 42% above where we were around COVID-19 crisis, and that's including the very, very conservative behavior, for example, of the Japanese central bank and so on. So it's not just the US economy, but that's like a global trend. So yes, we're going to have definitely a prolonged fiat currency debasement going on. But for the volatile assets like Bitcoin, I still would preach cautiousness. Why? Because if you go onto the daily of Bitcoin, I'm gonna focus a little bit here on the daily time frame. I still would think that is yet too early to buy. I would look and be way more comfortable at around the area of a 50-day moving average, around 58,000, just to keep it simple. And another area I actually like, for at least for the short-term bounce, I'd like that order block here around $61,000 to $62,000. Just to sum up, maybe like. Because we don't have so much time to go into every level, but I would say my view here would be following, like 61.5 to 65. That's a crab market level for now. I mean, unless you're a scalper with quite good confidence here, and I would not touch those levels so much. When we're speaking about the shorts, I think 65K is an amazing potential for short, and 69 needs to get flipped for the upside, for the definitive upside. So that will be your invalidation point for the short. And when we speak of the longs, I think, as I said, 57, 58, that would be a first big proper stab in the big liquidation for the longs. To be honest, Nick, I'm quite impressed because, we had around 650 million of liquidations and Bitcoin is still above 60K. I think,
Yeah.
we frankly speaking, I'm not very still happy about funding. I don't trade purely based on fundings, but we're still at close to three digit funding rates per year. So people are paying a significant premium, to keep their longs open. And I think those longs also need to capitulate. And that's exactly why I'm, despite my bullish outlook on the market, I'm still telling to our viewers to not buy right now, to place their stinky bits in the area of 57, 58. Wait for the bounce, wait for the CPI that's going to be announced on Wednesday. And then if we are not able to sustain the price there, then 52, 53K Bitcoin price, I would go quite all in, right?
Very interesting.
One important thing to mention that also, makes me feel quite cautious here. I am seeing, the Bitcoin dominance, despite it has corrected in the last few hours. I am definitely not trading the meme lines, but just for you to see, there is a certain break of structure that's took place on the chart. Apologize, I'm gonna make it a little bit more clean because obviously we don't need so many indicators for looking at dominance, but it is very, very highly probable, that Bitcoin from here, even with the slightest drops in its price, can give a very, very, very hard times to the alts. And you see that happens, like this environment where we have 2-3% drop in Bitcoin price and alts are holding in the beginning, and then we really clearly see those like 10-15% liquidation candles. I would be quite, I think in my opinion, they're quite probable to take place actually this week, because we already see, this kind of controlled selling in there. And I think a lot of leverage can be cleansed using that opportunity. I like to look on the total chart, when we see, for example, the areas on the total that I will be actually curious or willing to accumulate around. In my opinion, the first area would be around 2.2 trillion USD. So like,
Looking at that 50-day pocket, I mean, you can see how, like, if I look at your chart there, Russ, like back on total, while again, it's not exactly in there, it deviates slightly below, but like around that 50, 100-day pocket is generally speaking where Bitcoin bottomed last time during the post ETF launch correction. So you're kind of looking for long-term scenario. You think there's that ability for this to continue running up broader move alongside the broader move with equities, but you think really to start looking for value around this corrective range is where we usually would expect buyers and institutions to come in.
That's correct, Nick. I would say 2.18, 2.2, that would be my first zone of interest. If that zone does not hold, and again, here we need to be open to any potentialities, probabilities, I would really look forward to add a lot in 1.8 zone, because that would be actually the retest of the
prior resistance. Yeah,
exactly. Well, as I mentioned, I really like crypto here. However, in my opinion, we speak about other asset classes. I really also like commodities. I think uranium already, and you mentioned it multiple times and on the channel, I think uranium already starting to have those breakout moments. When I'm speaking about breakout moments, I also like to mention that commodities are operating on those very long, sometimes multi-decade long waves. And for those reasons, I really like charting, as Unique also very often do. I really like to see the negative charts. So when we are, for example, speaking about, let's say, silver as one of these precious metals, that's my actually favorite to pick up versus S&P 500. I'm going to bring the screen back. I see that's the reason why, for me, that chart looks very, very, very interesting here. And it's also, not just like talking from the purely TA perspective, but I also really like to observe this gold to silver ratio, because for me, this ratio is quite important to actually showcase for us. I'm on a daily right now, and showcase for us that despite the gold is used to be trading like pretty much 90 times above silver, I think gold is quite an inflated asset class that primarily used as a store of value. And here, I think the Bitcoin narrative is way, way, way more appealing for me. Please don't put me into the.
Russ, you're starting the gold Bitcoin debate, man, on the first episode. No, I'm just kidding. I know, no, but I see your point here. Like, I think ratios are incredibly important, and like you brought up the silver S&P 500 ratio, the gold to silver ratio. These things can give a ton of information. I know we've echoed on the channel as Russ mentioned before, but this is where Russ and I think relay a lot. That we love to watch ratios because
Mhm.
they'll give you clues that simple price action when all assets are generally appreciating. It's very difficult to lose sight that your asset might be up 5% that year, but other assets are 10%. So it can help you to find discrepancies over decade-long periods when things are really cheap, when things are overextended. So yeah, no, I
Big
completely
time,
agree.
Nick. Big
Yeah.
time, Nick. And for me, what's so important is that, of course, during those kind of inflationary fears that we just discussed 10 minutes ago, of course, gold is kind of the asset class across commodities that moves first. But there is a certain disparity. I mean, first of all, without going too much fundamentally, but like every Tesla and every electric vehicle, they need roughly 40, 50 grams of silver. Every smartphone needs 1.5 gram of silver, and so on and so forth. So silver has a huge utilitarian use. And the problem is that we are not producing 90 times more silver that we produce gold. So that or 86 times, we are like in a lower 20s. So without being like overly optimistic, I can still expect this ratio to correct all the way down here to 30-40. And for those reasons, I actually would expect silver to be in to move from current 24, 25. I would go all in around 24. But the thing is, I'm not buying silver itself. I also use an opportunity to have a higher better access to silver. And here I'm speaking primarily about the companies that are actually producing silver, that are mining silver. And this is the chart that is also doesn't look so good, but in my opinion, we are very, very close to the bottom here. We had this first break of structure. We are coming back and we are holding this order block. So in my opinion, the best risk rewards can be actually around the companies that are the silver producers, as the same way we had an accelerating move around uranium producers in the last year. We had a lot of 3-4x across the bigger players. We had a lot of 5 to 8x across the smaller players. So once again, if you missed this whole entire move, my point here is to teach in a way our viewers, and we're going to cover it in more details, how to position more into the asset classes that still did not have the move without the risk of losing it all, right? Because also
No,
downside, in my opinion, here is very limited. We are speaking about 10, maybe 15%. So if you missed, for example, the AI coin runs, or you missed the Bitcoin miners move, right? Like buying Marathon at 350 and having all the ride into late 20s. It is hard, to step in right now. Of course, the miners are decoupling from Bitcoin, but again, there's more tricks there. We will cover it separately. I think you also, and we will do it together, guys. I'd really love to onboard you into those and other theses, and most importantly, teach you how to find those theses by yourself, into going into macro and seeing what are the asset classes that still did not receive that additional chunk of liquidity coming in.
I think, to be honest, Russ, on that topic, it's so true that when you're macro trading or macro investing, you have to be looking where no one else is looking. You got to be looking at as many data points as possible to like see if you can really see the thesis playing out. And I think you mentioned with silver, like commodities move in these multi-year setups. And it was, I think initially oil and natural gas did very well when there was the reinflation of commodity prices. They generally led. Then you had uranium, which is something we've been kind of tracking since 2016. But to be honest, it really made its move this past year and last year and a half. That's when the
Right.
accelerated move came. And you can play equities on these. You don't have to trade the actual physical commodities, or you don't have to trade on futures contracts. But I think that there's so many. It's knowing about which plays to make, and even Bitcoin as well. If you view Bitcoin as almost like a digital commodity or a digital store of value, the miners heavily outpaced Bitcoin during that period of time, exactly to your point. So I think that if you can really know how to, like, what asset classes can you hold to bet on broader trends, and you can have really great risk reward setups. And I think that that's something, again, at the end of the day, you just got to be focused on those longer term swings. That's the sweet spot between day trading and I think more just long term buying and holding, which can have, in the case of Bitcoin, those 70-80% swings to the downside. But speaking of that, man, this actually, I think, comes to a good kind of closing topic. I think we've already gotten a good taste so far, Russ, but I would love, if you could, in simple terms and in very visual terms, describe, how you approach things as a trader. From what I understand in our conversations, you're a swing investor, you're macro, you love looking everywhere for opportunity. You're not pigeonholed into one market. Maybe, for example, in the case of silver, or another trend example, I would love to hear, like, how do you think of yourself as a trader? You also have a mathematician background as well. So I think that plays a huge role in assessing risk and reward.
Very true, Nick. Very good question, actually. I would love to share those because, first of all, it has been several times that I've been trading full time, and the number of months as my volume was significantly above, like 50, sometimes even 100 million USD. So that definitely taught me a huge humility, because I clearly understand that everything is possible in the markets. And one of the important things, I guess, that a lot of our viewers, and actually most of the viewers on YouTube, are missing, they can be very good in TA. It takes years, sometimes two, to really be a own TA profoundly, and then going more deep into other means of having the market edge. You can learn auction market theory. You can go into the order flow and see where the orders and how they're coming, and so on and so forth. But I guess, in my opinion, it's super important to also understand the market psychology and to master your own emotions when you trade. That's why I come up into every trade with a certain understanding that everything can be possible, and for every trade I am doing, I need to have my cost of invalidation, a cost of being wrong. I only like to approach very high probable trades. The reason why I was, for example, bringing those silver miner into perspective, because for the public company listed, for example, on Toronto Stock Exchange or New York Stock Exchange, the downside is quite limited, especially if they are not in the exploration phase, but already in the production phase. So they actually have tangible assets. They are having the balance sheets. They're having quite a clear trend on EBITDA. So yes, what can happen is that the revenues can go 20-30% down, but there's the upside that those companies can have is asymmetrical. And that's the reason why this is an interesting trade for me. In a worst case scenario, I would have an invalidation point and I would close my trade with maybe 10 or 15% loss. But the upside is providing me a good risk reward. So I'm happy to do that.
Cool. No, I think it's a perfect way to approach it, because in the case of something like silver, which, again, right now, not many people are excited about it. People aren't really focused on it. That always, to me, is one of the cues where I'm at least keeping it on my radar. Because it has that the potential for a big breakout when people aren't expecting it. But as you mentioned, in the case of silver miners, as a way to bet on silver's commodity. Silver has a long history, so there's a long time from history and price discovery. It's an established market. Outside of that as well, in the case of silver miners, if you have stocks that have been trading for a long time, you know how they deal with periods where they're burning through, they're losing money. Essentially, they can dilute shares, and essentially, you can eventually see, understanding all those fundamentals, when it's time to be able to bet on a trend, your vehicle in which you're going to be utilizing to bet on that trend. And essentially, you can have a very clear risk reward profile that's very favorable, because you're already buying something at, I think, a swing discount. In that case, it's historically cheap, and you're kind of pre-assessing against the trend. So no, I think that, again, man, that's very similar to how I approach markets. I try to buy contrarian bets, because that's where you're going to get the discrepancies. You're going to get the big moves. And yeah, man, no, I'm very excited. I think the silver play, you brought it to my attention to a large extent, so I'm keeping it on my radar for sure as well.
Very true, Nick. And one thing that you mentioned, and I really wanted to highlight attention to that part, as you said, when the trade is overcrowded, that's probably not going to be a good trade, especially in the markets like a crypto market with the high participation of the market makers, because we guys going to cover it in much more details. But you need to understand one thing: if someone on one side of the market is long, for example, you betting on a particular altcoin, for those trades to happen, the market maker needs to provide a liquidity to the market, so the market maker is short. So if you're expecting like a continuous 30% move in there, it's going to be not favoring the market maker. The market maker going to be losing money, so he actually needs to come back to this order block and rebalance. So that's exactly the reason why I'm saying, if we're going to go more up from here, first we're going to need to come back down and to tap into those very, very heavy liquidation zones first, because we still have a lot of leverage in the market and open interest is very high. So be careful, and we'll cover more into details what are the good levels for each alts.
Awesome, Russ. Man, dude, this was a first great conversation. We covered a lot of ground during this talk, and I hope above all, guys, you enjoyed the conversation. I know usually we don't do too many like interview formats like this on the channel, so it was great to have someone I think as intelligent as Russ on, who I've really gotten to know over the past couple months, and I'm excited to have you on the channel, Russ. I hope others as well will be excited to have you on and embrace you onto the channel. We welcome you to the DataDash family, and I'm
Thanks.
excited, man, to get to cover some of the topics that we're looking forward to covering.
Yeah. I'm very, very, very excited to go much more into details, and not just those several asset classes. I think, we as a macro traders, it's very, very important to actually be flexible and to see where the opportunity arises before everyone does. It's so exciting to be back into August 2020 in the DeFi summer, or like into Bitcoin price when you look back on the charts. But back then, how would you know? So you need a little bit of this contrarian thinking, and that's what we would like to do together.
Awesome, man. Very cool. Well, thanks again, Russ, for making the time, man. We'll be looking forward to having you on soon on the channel. And if you guys, if you enjoyed the video, definitely consider dropping a like down below. Drop some comments as well on some of the topics we discussed. It'd be much appreciated. We'll get a conversation going, and we'll see you guys in the next video. Take care, everyone.